Hello and welcome back to the Geordie Pig Investor channel, where we delve into the world of dividend investing to help you build a portfolio that pays you. Today we're diving into Bunzl, yes, that behind the scenes company that delivers loo roll and PPE, and why it might be just the underdog of the FTSE 100. After a dramatic profit warning and a 25% price drop earlier this year, the stock now trades at a 4-year low, yet analysts still see nearly an 18% upside potential. It yields over 3% and executives are snapping up the shares, which tells me confidence hasn't left the building just yet. So grab your popcorn, this one's cheap, arguably a bit boring, but could pay off if the recovery pans out. So first off, let's have a little look at what the company is. They're a British multinational distributor and outsourcing specialist headquartered in London. It supplies a wide range of essential non-food consumables, including packaging, hygiene, safety, and catering supplies. It'll then provide these to over 30 countries across the world in different sectors such as food service, healthcare, and retail. Operating through a service-led, tailored model, Bunzl consolidates products and delivers them on time and in full, helping customers reduce costs, improve inventory efficiency, and focus on core operations. Bunzl handles more than 400,000 stock items and has achieved over 11.7 billion in revenue in 2024, and it is historically dubbed as Boring Bunzl. The company is known for its steady, acquisition-driven growth, having completed over 170 bolt-on acquisitions to strengthen its sourcing and distribution footprint. Some key stats to do with Bunzl are they are currently priced at £22.56. Part of the industrials industry, have a market cap at 7.35 billion. When public back in 1957, have over 26,000 current employees, and the part that's really excited me about this business is that they have a 32-year dividend growth streak with a very healthy growth rate at 6.81% and a big yield that currently sits at 3.28%. Year to date, we can see from the graph they're actually down 31.73%. And in today's video, we're going to have a closer look at if this stock is undervalued and why I've actually been adding it to my own portfolio. First off, let's have a little look at the reasoning behind why I believe Bunzl stock has saw a recent share price decline. First one being their profit warning. In 2024, they decided to come out and say they had a profit warning for the company and that margins would be pressured due to easing inflation and weaker demand in some sectors. This spooked investors and led to a sharp share price drop, and a profit warning often signals that earnings growth may stall or decline, especially when it's coming from a steady company like Bunzl. There was also margin pressures with the company because as soon as inflation cooled, Bunzl saw lower selling prices for some of its products, particularly after the pandemic, because those types of products weren't as sought after, so categories like PPE dropped in price. And since Bunzl operates on tight margins and high volumes, even a small drop in pricing or volume can hit the company hard. And following on nicely from that one is the normalization of PPE sales, because during the pandemic, Bunzl benefited from a huge spike in demand for PPE and hygiene products, and that tailwind has finally now faded, and sales in that category have decided to come back down to sort of normal rates that they would have expected pre-pandemic, which has dragged down overall growth comparisons. So investors are just adjusting to the new post-COVID reality. You then have the current headwinds within the company because Bunzl earns a significant chunk of its revenue overseas, especially in the US market. A stronger British pound or weaker foreign currencies can reduce reported earnings when translated back into GBP, making performance look weaker even if the underlying business is still stable. And finally, we have the acquisition costs and integration risks. Bunzl's growth model relies heavily on frequent bolt-on acquisitions, and while this has worked well historically, investors are cautious about overpaying or facing integration issues, especially if interest rates stay high and financing becomes more expensive. So you might be thinking now, well, there's so many issues with the company, why would you decide to add this one to the portfolio? So now I'm actually going to go through the reasons why I believe you should consider Bunzl for your portfolio and exactly why I've added it to mine. First up, we have the attractive valuation. As we just recently shown on the first slide, they've had an over 30% decline in share price year to date, and Bunzl is trading at its lowest valuation in years despite solid fundamentals. For long-term investors, this presents a potential buy the dip opportunity in a high-quality defensive business at a discount. And leading on nicely from that is their defensive business model. Although sometimes you can think of a defensive business model as being boring, Bunzl supplies everyday, non-discretionary items like cleaning products, packaging, gloves, and safety gear, like I mentioned earlier. And these are reoccurring, stable demand items used across healthcare, retail, and food services, which makes Bunzl more resilient during downturns. So I find that particularly important with current levels of volatility within the market. And another reason I like this company is that they have a long track record of successfully acquiring and integrating smaller businesses. They have actually acquired over 170 businesses since 2004, and these bolt-on acquisitions expand margins, market share, and geographic reach while maintaining a capital-light model. And although I did say it could be a cause for concern, with their proven track record on the acquisitions, it's not something that I would personally have concerns about. Another reason why I've decided to add Bunzl to my portfolio is because I absolutely love the global diversification that comes with this company. It operates in over 30 countries, so Bunzl isn't overly reliant on any single region. This global footprint spreads risk and gives exposure to both developed and emerging markets, helping smooth out regional volatility. And as I've kind of mentioned in today's video, Bunzl is a more defensive play and not the flashiest, but it is considered a steady compounder, delivering predictable earnings growth, reinvesting wisely, and rewarding shareholders over time. It fits well into a sleep well at night portfolio for long-term wealth building. And one of the most important ones for me is remembering that it's only short-term headwinds. If you are a long-term investor like myself, then you can take a step back and think about the business over the longer term. With Bunzl, the margin pressures and PPE sales drop are likely only short-term, and it's not a structural issue. So this means that as inflation stabilizes and Bunzl adjusts its pricing and contracts, the business is positioned to recover and sentiment should shift quickly, which means the stock's price should see some joy in the coming years. And now we're going to have a closer look at Bunzl stock using Stockipedia. Stockipedia is a powerful stock research and analyst platform designed to help investors make smart decisions by combining data-driven insights with intuitive tools. It stands out for its comprehensive stock rank system, which scores stocks based on value, quality, and momentum, making it easy to identify high potential investments at a glance. One thing I absolutely love about Stockipedia is that you can create your own filters on here that suits your investing goals, and it will show you all the stocks on the market that are going to link up with that. So as you can see, I want my stock to have at least a 3-year dividend growth streak, a stock rank above 20, a dividend payout ratio that's below 70, part of the UK, has a dividend yield greater than 3%, has a market capitalization that's bigger than 500 million, has a dividend per share CAGR of over 5% over a 5-year period, and a dividend share growth of over 3%. And if I show you the stocks that have come up, this is across the entire UK market. There is only 5 that tick all the boxes. And as we can see, Bunzl out of these 5 is the one that has seen a bit of a share price decline as of late. And for me, as you know, I love to get into a stock when I believe it is trading at a discount. If you are interested in potentially looking into using Stockipedia, I do have a discount code in the description down below where you will save yourself a massive 25%. So make sure you click through my link to save yourself 25% if you do decide to sign up. And this is definitely going to be featuring in a lot more videos, especially my stock analysis ones. So you'll be able to see how the site works. And if you want a more in-depth analysis of the site, then I can do so. So please just leave that down in the comment section below. Something I love about Stockipedia is that it shows the last 10 years of historical data for any particular company. So if we scroll down, we can actually see how the company has progressed over the last 10 years. And if we start off by looking at the total assets, it's got a nice little graph here, which you can then see year over year how it has been progressing. And with Bunzl's graph, we can see that year over year, it is steadily increasing their total current assets. But if I am to scroll down, we can also see that their total current liabilities So to me, what is more important is looking at their gross profits and operating profits alongside their dividends per share. So if we click on the income statement part, we can actually see those numbers on here. If I scroll down, we can get a clearer picture. I love how they've got this little graph feature, as for me, it's a lot easier to see on a graph rather than trying to look at the numbers itself. So we can see the gross profit was 1.5 billion back in 2015, and that has been steadily increasing all the way up to 2024, where we can see it's actually over doubled since 2015. And alongside that, we can also see their operating profits has been steadily increasing over the last 10 years. So great signs right there. And actually something that's very nice to see is their operating expenses has sort of leveled out over the last couple of years, with it actually being higher back in 2022 compared to the last couple of years. So that is also a very good sign. If we are to scroll down here, we can see their dividends per share, which again is a very nice graph. Always good to see it going up and to the right, and that is exactly what this is showing, which means they're potentially buying back a lot of shares and also increasing that dividend on a yearly basis, which as a dividend growth investor is very important to see. One of the main things I'm looking for within a company is for it to be showing consistent dividend growth. One way to see this is by looking at the company's payouts throughout the years to see if it has been raising the dividend payment on a yearly basis. And as you can see on the chart, Bunzl has demonstrated consistent growth since that first dividend payment that it did actually pay out. So it's very impressive to see that this has slowly progressed over the years. And like I mentioned at the start, they do have a 32-year growth streak. But it's not only the fact they've got that growth streak, it's the fact that they are actually increasing it on a yearly basis at a very healthy rate, with their 5-year average being 6.81%. Now we're going to have a look at the intrinsic value for Bunzl. To work out the intrinsic value of a stock, I combine two key approaches. The first one being a discounted cash flow analysis, and the second one being a relative valuation. With DCF, I forecast the company's future free cash flows, then discount them back to present value using a chosen discounted rate to account for risk in time. This gives me a baseline value based on the business's own cash generating abilities. I then cross-check that with a relative valuation, looking at how similar companies are priced using ratios like PE, EV to EBITDA, or PFCF. By averaging the results from both methods, I get a realistic estimate of what the stock is truly worth today. When plugging in my numbers on the worst case scenario, Bunzl was valued at 3,135 GBX, which is a 28% undervaluation on the current price. On the base case, they were valued at £35.10, which is an undervaluation of 36%. And on the best case, they were valued at £38.97, which would be an undervaluation of 42% on that current price, with it being £22.56. I then use Wall Street estimates when analysing a company because they provide a broader market consensus on future earnings, revenue, and cash flow expectations. These estimates help me stress test my own assumptions and see if my valuation is in line with or diverging from what the market is expecting. It also gives context around investor sentiment and potential catalysts or risks that may not be fully reflected in historical data alone. In short, they help validate or challenge my thesis with a wider lens. We can see that the analysts are mainly bullish, with them believing over the next 12 months, on average, that they are likely to see a 20% upside. They have also predicted on the highest forecast that the stock could have a 45% upside, but on the lowest forecast seeing a potential 15% downside on the current price. Then once I've calculated the intrinsic value using both my DCF and relative valuation methods and factored in Wall Street estimates for an added layer of insight, I combine all that to arrive at my final buy price. This gives me a well-rounded, evidence-based target that reflects both the company's true cash generating potential and how the broader market values similar businesses. I also apply a margin of safety to account for uncertainties or forecasting errors, so my final buy price isn't just a number, it's a point where I feel confident I'm getting a long-term value with limited downside risk. For most companies that I value, I feel that it is great value on the average case price with some margin of safety applied. But on the worst case price, we can see they were valued at £25.27, so with a 10% margin of safety, you'd be looking to buy Bunzl at £22.74. And with a 20% margin of safety, you'd be looking to buy them at £20.21. On the average case, they were valued at £30.96. So with a 10% margin of safety here, you'd be looking to buy Bunzl at £27.86. And with a 20% margin of safety, you'd be looking to buy the company at £24.76. And on the best case price, we can see the company was valued at £35.76. So with a 10% margin of safety on the best case price, you'd be looking to buy the stock at £32.18. And with a 20% margin of safety applied, you'd be looking to buy the stock at £28.60. So is Bunzl stock a buy right now? I'm personally buying Bunzl right now because I see it as a high quality, cash generative business trading at a rare discount due to short-term noise, not structural weakness. With over 30 years of consistent dividend growth, a defensive business model, and a proven track record of steady compounding through acquisitions, Bunzl fits perfectly into my long-term dividend strategy. For any UK dividend investor, it offers reliability, global exposure, and consistent income, exactly the kind of stock that can quietly build wealth over time. At current levels, I feel it's a smart buy, especially after highlighting their financial strengths in today's video. And that wraps up today's deep dive into Bunzl, possibly the most boringly brilliant stock on the FTSE 100. It might not make headlines, but it literally keeps businesses stocked with everything from gloves to toilet rolls. So hey, it's wiping up profits while others are just talking about it. If you enjoyed this breakdown, don't forget to like, subscribe, and let me know in the comments what stock you want me to cover next. For now, this is the Geordie Pig Investor, over and out.